My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Coming up today, I was wrong. The Fed cuts 50 basis points. A look at Jay Powell's justifications. Reactions across social media. How will this affect inflation? All the knock-on effects across sectors. And where to now for me? You don't want to miss this one, guys. Let's go. Well, there we have it, guys. A 50 basis point cut. Turns out I was indeed wrong. I was given slightly better odds to a 25 basis point cut, as I didn't think it was necessary for a 50 basis point cut. However, like I said yesterday, I wouldn't be surprised if we did get the 50. Market was certainly pricing that in. However, I'm not complaining. It's actually a good thing for commodity bulls like myself, and for those of us that are positioned for the potential return of inflation, along with the continued devaluation of the US dollar. Bit of a green light for us today, actually. However, we got some strange price action across the market today. We initially ripped up to new all-time highs on the S&P before taking a swift U-turn. There's a look at the SPY daily chart, and just going down to the 5-minute chart here just to see the price action we got during the day. There was an initial release, 2 p.m. Eastern time. Market just absolutely shot up right until when Jay Powell started talking at 2:30, then pretty much did a U-turn and fell over. And stick with me because I'll explain in a minute why I think that happened, and I'll also show you a list later of some interesting ETFs that actually gained on the day, even though we actually finished pretty much flat, if not down, led by the Nasdaq, falling the most. Small caps holding up the best after they had a really good initial rip afterwards as well. And so this is not quite like September 2007. The last time the Fed started a new cycle with the 50 basis point cut, we ripped up really hard. We actually did a bit of a reversal shooting star pattern there today. And so I'll show you how I'm reading all of this and what I'm thinking now and how I plan on positioning going forward, given this really aggressive start to a new rate cutting cycle, which typically doesn't bode well for the stock market looking back in history. I'll show you some stats on that as well. I got the size of the initial cut wrong. However, surprisingly, I did get the call on TLT to pull back today right. Again, a bit of a surprising move from the bond market. We'll also take a look at some commodities later and the price action we're getting out from them, along with the US dollar. And so part of the reason yesterday why I think the Fed was going to, or should I say should have, started with a 25 basis point cut, instead of what's usually considered a crisis level cut, is that we simply don't have a crisis in the US economy at the moment. Just looking at recession risk indicators here, on the Franklin Templeton website, one of the largest asset managers in the world, they're actually improving. We can see back in March, overall, there was a yellow signal with 7 individual yellow signals. Started improving in June, but there was still 7 yellow signals. Then the latest read we've got, there's now only 4 yellow signals, with the negatives being in jobs, ISM, and yield curve, but the overall signal is up. I'm actually in the middle of developing a new economic trends indicator myself in TradingView, and I too have the current reading as the economy in expansion. Although for sure there are risks building in the jobs market, my point is for the here and now we don't really have an emergency in the economy that I didn't think would justify a big move to start with. And the Federal Reserve themselves, with their own GDP Now forecasting model, is still estimating the US economy is growing at an annualized rate of 2.9%. That's data from today, and that's been trending up as well. In other words, the Fed themselves, just like we heard from Jay Powell today, says the US economy is doing fine, it's growing, everything's great. Even Goldman Sachs came out again today and also increased their GDP tracking estimate for Q3 now to 3%. They too were also expecting the Fed to cut by 25 basis points. Quite a few of us got it wrong today. Congrats to those out there that predicted the 50 basis point cut. You were indeed right. Or is this a political decision, as some are now accusing the Fed of doing? Can you imagine if I told you a year ago the Fed's not going to do any cutting until their last meeting before the election, and they'll start off with the 50 basis point cut? One would assume the economy would be falling off a cliff, but what happens if I also told you the stock market was at an all-time high, CPI tracking around 2.5%, unemployment 4.2%, along with GDP expected to keep growing at 3%, but the Fed still cut by 0.5%. And it's well known that the Federal Reserve is supposed to act independently, free from influence from Washington leaders. Did Jay Powell cave in to Elizabeth Warren's demands for a 75 basis point cut? He was copying a lot of political pressure to deliver a big cut. Or has Janet Yellen loaded so much short-term debt onto US taxpayers that Jay Powell's got no other option but to bring down the cost of servicing that debt for the US government, with it now standing at $35.3 trillion. That's $269,000 of debt for every taxpayer in America. And again, most people don't make that real connection. However, that is a real debt hanging over the head of every American taxpayer that them or their kids and grandkids will have to pay back somehow, some way. Either way, it doesn't matter the rhyme or reason. The fact is he cut by 50 basis points. We all have to accept that. Whatever really the reason why he did it, the fact is monetary conditions are getting loose again. That's actually good news for asset owners like myself. Or was there so much pressure and narrative around a 50 basis point cut, not only from some senators demanding it from him, but also from the market? And even though this article says the stock market got just what it wanted from the Fed, say it's more of a case of the bond market. Once again, it looks like the 2-year was right, and that huge gap between Fed fund futures, that really weakness in yields of late. Nonetheless, the Fed put is back. He's 100% going to backstop these markets. No way we're going to see a crash before November. He's now going to be very accommodative and try and keep the good times rolling. Fed members on average are penciling in 2 more cuts this year when they meet in November and December, 25 basis points each. That'll give us a full 1% in cuts for the year. However, not all Fed members were on board. We had a dissenting Fed member for the first time in almost 20 years. Federal Reserve Governor Michelle Bowman cast a lone dissenting vote. She thought the Fed should have only gone 1/4 of a point. And there's a look at the new Fed dot plot, where each Fed member privately gives their forecast to where they see the Fed funds rate will be out in the future. You can see quite a bit of dispersion. We've got some Fed members thinking the rate will be over 4% next year. Others think it'll be 2.8, 2.9, with the median forecast around 3.4. And so I'll show you now a series of posts on X today from multiple financial influencers and what their reactions have been to this cut. The first being Sarah Eisen from CNBC, said 3% estimated growth, 4.3% unemployment, and above target 2.5% inflation with stocks at all-time highs is a surprising backdrop for a double rate cut. She went on to say the Fed's attempt to explain a large rate cut that Powell said in July was not something we're thinking about right now. It has been quite the quick about face from Jay Powell. As based on the incoming data since July policy meeting is unconvincing, which is true. What's really changed since July? It's a little bit of softness in the jobs market, not much. Unemployment's 4.2%. Actually went down on the prior month. And once again, Brian Sullivan, also known as Sully, from CNBC, which they don't normally speak out too harshly against the Fed. They normally play it pretty safe on social media. Also came out today and said totally confused by the Fed rate cut decision. Yes, I was in the no rate cut this year camp, so clearly wrong, but all we keep hearing about is how good the economy remains and how inflation is coming down. Powell said today the economy is strong overall, his words. Now they make a move, a 0.5% cut, normally reserved for weakening economies. Bizarre. We also got a PhD economist today saying the economy is so strong and the Fed's so independent that it decided to bail out the treasury and admit evident weakness in the middle of an election with $2 trillion deficit and $35 trillion debt. Also from one of my favorite economists, Mohamed Al-Aran, Powell had to navigate the contradiction between the unusual step of starting a cutting cycle with 50 basis points and the repeated assessment that the economy is in a good place. He didn't want to acknowledge that today's move's a catch-up for not having reduced rates in July. With him going on to say he just recalibrated what it means to start a cutting cycle with the 50 basis point move. Keith McCullough, CEO of Hedgeye, Fed devalues the US dollar and purchasing power of the American people. With him going on to say, within 3 to 6 months, inflation will be re-accelerating and the Fed will tell you no one saw it coming. Another post, the biggest losers today, the middle class, because this will do nothing to help with inflation. With him going on to say, the pain of inflation is everywhere. Has your salary increased 30 to 40% since 2021? Because that's what the price of a lot of our goods and services have. Another one from CNBC, Steve Grasso, shocked at 50 basis points, not the typical personality of the Fed, as he reposts this chart from Zero Hedge showing the similarities of CPI inflation to the 70s. Another one, 0.5% cut is panic. Powell is intentionally causing an inflationary bear market to delay a crash and make a recession far worse. Combined with Yellen holding the yield curve inverted for the longest period in history, we aren't getting out of this without mass unemployment and poverty. Another Fin influencer, there is only one reason why the Fed cut 50 basis points this week. They must get front-end rates lower as this colossal wall of debt matures. And I really agree with that one. Marko Klanovic, with asset valuations near record highs, latest data okay, and about a month to important elections, plus some senators pushing, 50 basis points is not a good look. And with the popular Zero Hedge adding, the economy is so great, it needs a crisis level rate cut 2 months before an election. And finally with Dan Ives, just posting a photo of some white doves, implying the Fed is really dovish. They're really loose in financial conditions, been really accommodative at a curious time. And that's the thing, isn't it? The last time the Fed started a new rate cutting cycle with 50 basis points was when we had a global pandemic. The whole world came to a grinding halt. Back in late 2007, when there was serious signs of deterioration in the real estate market, subprime mortgages. And then back in early 01, after the tech bubble burst and the economy was deteriorating quickly. What exactly is the reason this time? You can't just say they're worried about a recession or the jobs market's just softening a little bit. We've had that signal plenty of time. The way I see it, Jay Powell knows something or sees something that he didn't admit to us today, and the economy is about to fall off a cliff and go into recession. He just doesn't want to say that right in front of an election and spook markets. Or we don't go into that recession. The other option we get is a 1970s style resurgence in inflation. He's loosening monetary conditions with assets near record highs. And so in my opinion, he's more than happy to swap the risk of a recession for the risk of inflation. How if we get more inflation, a lot of the middle class is already squeezed on prices. I don't know about you, but are you ready for the price of your goods and services to go up another 30 to 40% over the next 4 years if this current government stays in power and keeps on their spending trajectory while we've got interest rates coming down? Like I said, this move today is just another green light for commodity bulls and those positioned for further weakening in the US dollar. But there was quite a few knock-on effects today amongst the really volatile trading we got, one of them being solar stocks, really big beneficiary of lower interest rates. Since they're a large ticket purchase, a lot of people finance them, so it's really sensitive to rates. And we can see that in that rip up today in the solar ETF. At one point up almost 5% on the day before it too took a sharp reversal. Just looking at the 5-minute chart here in mid-afternoon, finishing the day flat. However, just keep in mind on these Fed days, we can get this messy price action up and down. It's typically not to a day or two later the market can make up its mind. But this time was different from the past. Just looking at history here in the light blue line, it's how the S&P performs on a single day, 9:30 in the morning to 4 p.m. in the afternoon. When we get a 25 basis point cut, on average finishes down slightly. With all cuts in the dark blue, we finish up a little bit. However, if we get bigger than a 25 basis point cut, typically the market loves that, and on average we finish up 1%. S&P 500 and Nasdaq actually finished lower today, with small caps pretty much finishing flat. This also comes at a time when analysts have got forward earnings expectations at all-time highs. Just looking at data from FactSet, for the third quarter, S&P companies are expected to report year-over-year growth in earnings of 4.9% and revenue 4.8%, and that actually expands going into Q4, along with revenue expected to continue expanding into next year. And this is why today's rate cut should be music to the stock market's ears. We've still got really good growth in revenue and earnings. Now the cost of capital is coming down, the yield earned in money market funds and bonds coming down. All that should make stocks look a lot better. And so as we know, the S&P 500 finished down today. So did the Nasdaq. It's actually a pretty uneventful day. Looking at the Nasdaq Qs here in terms of range, just looks like another sleepy old day in the market. There's the Russell 2000. It spiked up really hard as well. However, did a bit of a U-turn. But as promised earlier in this video, I was going to show you a list of ETFs that actually gained on today. I did a bit of a screen. Looked for liquid, non-leveraged, non-inverse ETFs, just plain vanilla funds that gained on today. Interestingly, what came out on top of the list was the Argentina ETF. That holds Argentina stocks. The best gainer of the day, up almost 1%. And so what that tells me is that we might be seeing a bit of a continued rotation into non-USD assets. We also saw that with the agricultural commodity fund trading up today. Saudi Arabia stock market, international small caps, copper miners, Turkey shares. Also interestingly, mortgage REIT income ETF with a huge dividend yield of 10%. Oil and gas exploration, Indonesian shares, and Singaporean shares also rising on the day. Pretty much anything but US equities caught a bid today. But it was interesting looking at dollar futures. The dollar actually sold off hard as soon as we got that announcement from the Fed. Took out that big 100 psychological level, but proved to be a bit of a fake out as it too reversed course into the afternoon. And so we got a bit of an interesting candle here on dollar futures. Bit of a spinning doji kind of hammer style formation, which is normally bullish. Maybe this has been a bit of a sell the rumor, buy the news event, and we actually get a bit of a bounce in the dollar here, along with a bit of a pullback in gold, as it might be getting to be a bit of an overplayed narrative now. Short dollar, long gold. It's been working really well of late. Maybe now we get a bit of a retracement profit taking, and that could prove to be a bit of a shakeout, and maybe sets up another good buy the dip opportunity. And fundamentally what's happened here today continues to play out in this long-term trend of a weak US dollar, which helps the price of everything else that it's priced in. And interestingly, we got a little bump up in US government bond yields as well. 2-year getting up to 372 today, along with the 10-year, which is interesting because that too could also be a bit of a sell the rumor, buy the news event. And maybe we see a bit of a bump up in yields, even though the Fed's just gone fully dovish. It may confuse a lot of people, but again, could be setting up for a bit of a shakeout. High yield bonds not phased at all, actually gained on the day. Like I said, credit markets not freezing up. High yield bonds are saying the economy is going to be fine and there's no immediate dangers right here and now. Also, just looking at the St. Louis Fed Financial Stress Index. Again, this is data coming straight from the Fed themselves, just how they've got GDP tracking at 3% this year. This index looks at a lot of things: liquidity in the markets, credit markets, other signs of stress. And you can see that really start spiking up even in early 2007, letting us know things are not okay. And that's where the Fed did a big 50 basis point cut. And of course, we got the GFC, same again in COVID. But look at us now, down near multi-decade lows. There's just simply no material amount of stress across financial markets. So like I said, does Jay really see the economy falling off a cliff? He just doesn't really want to say that. Or is he totally fine for inflation to come back so he can bring rates down for the US Treasury to refinance debt? Maybe help keep his masters in power along with his own job and just keep kicking the can down the road, let someone else deal with inflation by the time they're all gone. And just looking at crude oil today, actually pulled back somewhat after government data showed US crude inventories fell last week, and it too gave a bit of a muted response to the Fed's decision today. We also got news that Israel just did another attack, this time using smartphones, intercoms, crypto devices, tickers, smartwatches, solar panels, and even some household appliances within the homes of Hezbollah members across the country. As reported yesterday, they managed to blow up about 3,000 pages simultaneously, inflicting a lot of casualties on Hezbollah members. It was believed they hacked the batteries. However, now it's looking like they infiltrated Hezbollah's supply chains, intercepted them, and added some explosive devices into them before shipping them out. And apparently it was a shell company set up by Israel. So not only did Hezbollah buy all these devices straight off Israel themselves, they also sent them with a little gift inside. And so we thought their ability to cyber hack devices and cause their batteries to explode was clever. I'd say this is even more clever. Intercepting their supply chain and compromising them is a big blow to their enemy. But let's not forget, Hezbollah has been sending hundreds of missiles into northern Israel as recent as last week, and this has been going on for months. And like they say, all is fair in love and war. And just moving on to an interesting post today about John Paulson. Some of you may know about him. He was actually written about in the book The Greatest Trade Ever, in which he shorted the subprime mortgage market, making over $15 billion for his firm, in which that's said to be the greatest single trade ever made on Wall Street. But interesting, we're getting news today that he plans to pull money if Camilla wins the election. He said he would withdraw his investments from the market and move into cash and gold if she wins the election. He's voiced concerns about her economic policies, including the increasing corporate tax rate, raising the capital gains tax, and introducing a 25% tax on unrealized gains for wealthy individuals. He warned these policies could lead to mass selling and market crashes, predicting a quick recession if enacted. And that's a pretty strong viewpoint, isn't it? Coming from a big investor like that, a billionaire who said he's going to pull his money out of the market if that happens. I wonder how many other billionaires are thinking the same thing. They're just too afraid to go public with it and voice their actual opinion, like John has. But for myself personally, like I said at the start of this video, where to now for me? Well, it's just added conviction to a place I'm already in. As many of you know, I'm a commodity bull. I've recently been diversifying my portfolio over the last month or two into assets outside of the United States. International stocks, even though they're listed as ADRs in New York. It still deleverages my portfolio away from the US dollar and what I see as building risks in the US market over the next couple of months, especially if we do get these communism style policies enacted. Now add on top of that a really dovish Fed, loosening financial conditions when they don't need loosening. That just sets up for a resurgence in inflation, or at least significantly increases the risk. And looking back in history, commodities and inflation are often positively correlated. And so just looking inside the private members area for my stock pick service, at the current geographical exposure for my stock picks portfolio. You'll see that I've currently got 43% of the portfolio exposed to American companies, and after today's move, my new target for this range going forward is going to be between 30 and 40%. I want to get that a little bit lower, and my next stock pick for members this Sunday will be another non-American international stock. And for those of you interested, portfolio is currently beating the S&P 500. It is in the green, and in my opinion, we're still only getting started when it comes to small caps, international stocks, commodities, as we just got a really another good signal today. But don't get me wrong, the US is still the world's home to capital, still has the world's leading and some of the most innovative companies out there. I will always invest in US markets. I'm just worried about what the current leadership could do to those markets going forward, and I at least want to diversify and hedge those risks away. But one area America's leading in is that of space exploration, and we could very well be at the beginning or near the beginning of a new space bull market. We just saw space stock Intuitive Machines rocket 50% after a new NASA contract, as they just announced a new contract worth up to $4.82 billion from NASA to provide communication and navigation services in the near space region. Key part of the agreement is for the company to deploy a constellation of lunar relay satellites to support NASA Artemis moon exploration program. And so I showed you guys last week another space stock, Rocket Lab. It's been getting a lot of action of late, ripping up on volume, and there we are today with Intuitive Machines. It too pulled back and reversed, but still finished up 38% on massive volume, 141 million shares traded, still with a market cap less than 1 billion. And just going out to a weekly logarithmic chart, you can see big signs of accumulation in this stock. And so this is definitely a sector I'll be investing in the near future when I see the right setup on the right stock. And like I said, some of the best stocks in the world do come out of America. They do have the biggest opportunity, just like this one here, coming out of Houston, Texas. So don't get me wrong, I'll always invest in America. I'm just trying to hedge away my risks of further deterioration in the US dollar. And regardless of the US dollar, I still think there's a lot of other key drivers for commodity stocks and international stocks as well. A lot of great value and dividend yields out there as well. My stock picks portfolio has a dividend yield close to 2.5% now, while still owning really great growth companies with low debt. There's a look at your economic calendar today. Housing starts coming in better than expected. In fact, we got a massive jump month over month, 9.6%. Building permits jumping as well, just like we saw industrial production come up. US economy is still currently expanding. But there's the Fed's interest rate decision coming in lower than what most economists had forecast, including myself. Also interesting today, even though we got really messy price action in the main indices, Brett's held up pretty good. There's 52-week highs on the NYSE and the NASDAQ as well. Monthly high on Brett. Got a little pop in volatility, 18.2. Option dealers still thinking there could be some more volatility around the corner. 5.5 points of premium above realized. And we got a little bit of an outperformance of small caps versus large. Now back above their 50-day as well. And wouldn't you know it, inflation expectations are as well. Look at that, curling back up. Semi is one of the hardest hit sectors today, down over 1%, along with gold miners as well. Bit of a shooting star reversal candle there. Like I said, we could be in for a bit of a pullback in gold now, along with a bump up in the dollar and yields, causing everyone to kind of scratch their heads and say, what's that all about? And we could be in for a decent shakeout. Interestingly, defensive sectors came off today. Really mixed day out there today. Quite a lot going on. And a look at the biggest stock, Apple, actually did pretty good, up 1.8%. Microsoft went the other way after it's been on a pretty good rip the last week. There's a look at Tesla, and Nvidia actually fell again today, back below its 50. Energy bounced beautifully last week after we got that hammer candle formation. There's ExxonMobil and financials, still under a bit of a pressure of late. Interestingly, out of all the sectors I track, it was actually global shipping ETF that was up the most today, and after that, regional banks. Just going back, looking at market color, like I said, we're mixed all over the shop now. There's that bump up in inflation expectation. High yield bonds still flying. The defensive's coming off up the front. Bit of a pullback in gold. Bump up in energy. Growth sectors doing fine. Small caps now outperforming, but just really mixed overall. I think this market needs a few days to kind of settle down, find its footing. And are we really going to kind of bounce off this resistance zone? And the market just did a fake out to all-time highs. Was that it? Was that the top? Are we repeating September 2007? Or are we going to do a shakeout and we're back to new all-time highs before we all know it? Either way, interesting times in markets. But like I said, even though I got my Fed forecast wrong, in the medium long term, what they're actually doing is good for investors like myself. Like I said, it just increases the chances inflation comes back, and that's good for commodities and some other international stocks as well. As always, I'm interested to hear your thoughts about all this. Did Jay Powell do the right thing? Where do you think the markets are going to go to from here? Did he succumb to political pressure? Does he see something that we don't? Is he happy to swap a recession for inflation? I'm interested to hear all your thoughts about all this. Thanks very much for sticking with Click Capital, and I'll be back again tomorrow to break it all down for you again. Cheers.